We have started discussing the risk and term structure of interest rate. I hope you all can see the slides now. Risk and term structure of interest rates, we started discussing and we have gone up to the point where we have discussed about the theories that explains the term structure of interest rates, and I believe I have finally covered the expectation hypothesis in our last interaction. But I'll try to very briefly touch upon the points that we have discussed up to that point on this topic. Before that, if you have any question, you can either raise. If not, you can actually put them down on the notice board so we can follow up any clarifications required. Right. So from your silence, I think I feel that you are comfortable in listening the discussion that we initiated. This risk and term structure remains one of the very, very interesting as well as very important area in terms of analyzing interest rates. And particularly when you talk about risk structure of interest rates, right? We look at risk, liquidity, and income tax rule. Okay, whereas when it comes to a term structure of interest rates, what we are looking at is different terms to maturity. That means the duration, not 3 years. We look at like 3, 5, 8 different times to maturity. But these are same characteristics, let's say bonds, but still you could see their interest rates are different, right? So that's the term structure. When it comes to risk structure, we look at the same maturity, let's say 5 year. What you are now seeing is the term structure of interest rates that we were discussing, where we were broadly highlighting the difference in terms of risk structure. When I say risk structure of interest rate, I was explaining all throughout the characteristics such as risk, liquidity, and let's say tax consideration, but same maturity. For instance, 5 years. But the interest rates of those are different because the risk characteristics that we were discussing drive those interest rates to be different. But when it comes to term structure, we look at the same kind of risk, liquidity, and tax considerations, but we change the maturity structure. We don't look at only 5 year, we look at a spectrum of maturities. So these maturities still drive interest rates to be different. So that's been explained through various theories. Those theories are the ones that we were discussing in our last session. So what I'm trying to explain here is we look at this risk structure in terms of default risk, liquidity considerations, and tax consideration, and I highlighted and explained in my previous sessions where the bonds with these different characteristics still carry different interest rates, and then this was explained in terms of so-called rating, credit rating structure, and the rating structure also kind of, pool all these characteristics and symbolize based on standards accepted arrangements by these rating agencies, mainly the 3 global rating agencies that everybody is familiar with: Moody's, S&P, that is Standard and Poor's, and then Fitch. These are the 3 rating agencies. They kind of symbolize these elements that we were discussing, and then based on that they bring you a kind of standard notification. By looking at that notification itself, you can kind of figure it out, level of risk, level of liquidity, and other consideration embedded in a financial asset, in this case the bond. So we looked at those, and we more or less detailed out, and we also discussed in terms of what these rating agencies look at and how they derive some of these rating symbols, and based on that the investors get a kind of a feel about these financial assets in greater details. Then we move to the risk structure, the term structure, and of course you are familiar with this supply side, demand side behavior of bond market, and through which what happens to the prices. I'm not trying to elaborate that again for the clarity, because most of you all have listened to the greater discussions we had done those in our previous recording as well as in our previous class. So when you look at the term structure of interest rates, we are looking at now identical basket. Risk, liquidity, tax consideration. We are coming to a identical characteristics financial assets. For instance, government treasury bonds, US treasuries, right? US treasury bond is called US treasuries. Okay, so you see these financial assets. They are characteristics of risk, liquidity, and then of course tax implications are no different. But the time to maturity, if not the duration, is different when it comes to different maturities being requested, invested by investors all around the world. So these difference in terms of maturities also drive their interest rates to be different, right? So when the interest rates to be different in the circumstances of identical characteristics, there are theories which explains these differences, right? So in this exercise to kind of arrive at different theories explanation, we also looked at the yield curve. Yield curve is very, very important yardstick in today's economics as well as in financial markets to figure out the health of an economy. I was explaining in my previous discussion, if you look at US experience, when the US see their yield curve is downward sloping. In this slide, what you are seeing is inverted. Downward sloping is inverted, where the short-term interest rates are higher than a longer term. If not, longer term interest rates are lower than short-term interest rates. Usually, a yield curve is upward sloping, like a staircase. You walk up, right? So the steps are there, you climb up, right? So what you are basically seeing is when it comes to an inverted yield curve, short-term rates are higher and the long-term rates are lower, right? There may be circumstances in the yield curves, you will see this. But what US reads from this type of characteristics in their term structure of interest rate, they try to interpret that if there is a inverted, if not downward sloping yield curve, the economy is heading for a recession 6 months down the line. 6 months from now, economy is heading for a recession. That's how they interpret it, because they have seen through empirical evidence in the past, through pooling of different time periods, experiences that US economy gone through, that the yield curves, when it signals a downward slope, that implies that the economy is heading for a negative economic growth. That means economy is not growing, shrinking. right? So that's the characteristics through which the importance of yield curves are analyzed in today's context. Mostly the yield curves are upward sloping, where the short-term rates are lower than long-term rates. You will come across yield curves flat, where no difference between short-term and long-term yield rates. And you will come across downward, if not inverted shape yield curves, where the short-term rates are higher than long-term rates. Okay, so similarly, if you take this details into the theories that explains these term structure behavior, we look at three main theories. One is expectation hypothesis or expectations theory, and the other one is segmented market. Third one is liquidity premium, right? So with liquidity premium, I combine another one, so you don't need to worry about that. I'll bring that into the discussion as we move on. In our last classroom, if not last discussion, we have basically discussed about this expectation theory. What we discussed there is expectation theory tries to explain the fact that short-term interest rates and the long-term interest rates relationship. What it concludes is long-term interest rates are nothing but the average of short-term interest rates that would occur during the lifetime of a financial asset. So the example that we took and discussed in the classroom was that we were looking at, let's say, 2-period bond, right? 2-period bonds interest rate in the market today is nothing but the average of 1-period interest rate of a 1-period bond today in the market plus 1-period interest rate of a 1-period bond 1 period from now. Okay, so if you see today's 2-year interest rate, let's say 8%, right? So that should be nothing but today's 1-period interest rate, let's say 6%, and 1 period from now, a 1-period interest rate. That means the second year, that means from today, you finish 2021, 2022, one period, the bond interest rate is, let's say 8, right? So today 1-period interest rate is 6. Then 6 plus 8 divided by 2, it should be 7. So if today's 2-period interest rate is 7%, as per the expectation hypothesis, investors are no different between buying a 1-year bond or buying a 2-year bond today itself. So at any given moment, there is a difference in terms of interest rates in the market that opens up arbitrage opportunities. Let's say today, based on the example that we discussed, 1-year bond is 6. Next year, 1-year bond is 8. Today, you are seeing a 2-year bond is 7.5. So effectively, that motivates investors to buy today's 2-year bond. What happens when everybody start buying a 2-year bond today? Price of 2-year bond will increase because of the additional demand. You know what happens to the demand curve? That shifts to the right. So as the price increase, what happened to the interest rate? interest rate decrease. So that automatically takes out the arbitrage available with the 2-year bond in the market today. So the expectation hypothesis drive this behavior, either side of the equation, short term, long term, depends on the market perception, and make sure the market always works on the basis of that the short term interest rates are actually the driver in terms of determination of long term interest rates. The long term interest rates are nothing but the average of short term interest rates. So this is the conclusion of the expectation theory. And we have derived this in terms of the formula, standard formula, and I have explained these things. And ultimately, what we basically concluded here is a 1 period interest rate can be extended to not only the 2 period, but nth period, that is how many periods you wanted to look at it. So you had to basically take that into the equation, right? The expected interest rates of next 1 periods that could happen over a period of, let's say, 10 years. So ultimately you will end up with a 9 period shorter term interest rates also in the equation divided by 10. So effectively you will see what is the today's 10 period interest rate. So anything you see better than that, you will demand that financial assets. As a result, the demand would increase the longer side of the equation, and the prices would again equate. If not, if the short term is beneficial, people will start buying short term, and because of that, prices would increase, short term interest rate would decrease, and that match with the long term interest rates. So this is how the market is bringing the equilibrium in terms of expectation theory. Right? So this is what we discussed, explained, and a great extent understood in our last classroom discussion. Then another interesting theory, that is segmented markets theory. Segmented. Markets are segmented. I mean, this is true. If you are working for a bank or a treasury, you are reasonably familiar with what's happening in financial markets, you will come across that the markets are segmented. Okay, so you will see there is a segment in the market which is always in preference of short-term bonds. For instance, money market funds. The commercial banks often short-term deposit-based funds, right? So the general individual investors, they also not sophisticated, not necessarily aware of how the markets work. They also, to some extent, not necessarily take a longer view. So they may prefer short-term financial assets. But there's another segment in the market, right? They are always preferring longer-term financial assets. Can anyone say what type of institutions that comes to your mind when we say the investors who prefer longer-term financial assets? Anybody? Right. So you know the pension funds, right? So you know the markets where the insurance pension funds they invest often in longer term assets, right? So they basically invest in longer term financial assets. Let's say EPF. You all know EPF. Their obligations are also to some extent long term. So they prefer long term bonds to be purchased from the market. Similarly, you will come across life insurance funds, not mostly the general, but life insurance, like their obligations also long duration, long term. So they prefer long term financial assets. So they can match their obligations, long term life policies, with financial assets and thereby take out the market risk in the equation. So the markets are segmented. One side of the market, short-term market participants, other side of the market, medium to long-term participants. Right? So these segments in the markets are often play, if not demand, their financial assets in their respective segments. Therefore, in the case of segmented market theory, bonds of different maturities, one period to long periods, they are not substitutes. In the case of expectation theory, they are perfect substitutes. In the segmented market theory, bonds of different maturities are not substitutes. You are in the short-term market, you have a demand curve, you have a supply curve. The pension funds, insurance funds, they are in the long-term market. They have a different demand curve, they have a different supply curve. They play their role in their respective markets. Okay, so the interest rates for these bonds in these different markets are determined through its own demand and supply forces. Right? So the long-term investors would compete with each other and determine what's the equilibrium interest rates in the long-term market. The short-term players in the short-term market, they would interact between the suppliers and demanders and would determine what the short-term interest rates in the market. Okay. So the natural phenomenon here is that the investors have their preferences. They have preferences of maturities over another maturity. So they play their general role in their respective markets. Right? So then you can figure it out, the fact that generally more investors prefer short term that has lower interest rate risk. That is the duration element. Longer the duration, what happens there is greater the uncertainty. So I was repeatedly explaining all throughout in our discussions. So the longer the duration from now, anything could happen to anything that we are aiming at. But shorter the duration, there's some certainty in terms of what we expect and what we could achieve. Now, from today to end of this month, you know there's a lockdown in imports. Right? So the enforced lockdown is to some extent gives you a certainty in terms of your movements. To some extent, I'm also not having my session conducted from the IBSL today simply because of this arrangement. But 3 months from now, it's uncertain whether we will continue to have lockdown or after the first announcement of this 10-day period, we might see this lockdown would be taken out and people would have return into their activities, but with health-related guidelines being followed. right? So the possibility that longer the duration, the greater the uncertainty, that drives more people to demand shorter term financial assets, bonds in this case, and naturally more demanders are in the shorter segment of the market compared to longer segment of the market, where the pension insurance funds are usually the driving forces. Right? So when you see more people demanding financial assets at the short end, it is natural the demand curve for short end is generally is greater. What that means is higher the demand, what happened to the prices? Higher the price. Higher the price means what happened to the interest rates? Lower the interest rates. So when you see shorter side is lower, it naturally explains the longer side is higher. So it sets and explains the third fact that we were trying to understand through these theories, that the yield curves are usually upward sloping. What is upward sloping? Short-term interest rates are lower than long-term interest rates. Short-term assets, because of higher demand, higher prices mean lower interest rates. So the yield curve here is upward sloping. Segmented market, very clear that the markets are segmented. Therefore, the bonds are not necessarily substitutes, right? So what it drives here is more people are in the shorter side of the market. As a result, shorter demand is high. Short-term demand is high means the price is high, interest rate is low. So when the short-term interest rate is low, it naturally explains that the long-term interest rate is high. So when the short-term interest rate is low, long-term interest rate is high, the yield curve is upward sloping. Okay, so you see that element explained through the segmented market theory. Then you see the liquidity premium theory, and I'm just combining this with so-called preferred habitat. You see preferred habitats. In the jungles, you have certain habitats. So the animals don't live in the places where they feel to some extent risky. Certain animals, certain type of animals live in certain areas of the jungle. So their habitat. And even in the houses, you probably feel comfortable in certain location of the house. That's maybe your room or living area. The parents would be much more comfortable in certain area of the house. So that's their preferred habitat. They have the preferred location within the total setup. Similarly, in the bond market, financial markets also, there are preferred location for market participants. So the preferred habitat theory is that we will come to that and explain. Okay, so the liquidity premium theory that explains the fact that the interest rates on a long-term bond will equal an average of short-term interest rates expected to occur over the life of the long-term bond. When I read this, it naturally comes to your head now that this is the same part, same component, we figure it out in the expectation theory, expectation hypothesis. Long-term rates are nothing but the average of short-term rates that could occur during the lifetime of the long-term bond. Then they say plus. Plus a liquidity premium that responds to supply and demand condition for that bond. So what it says is the expectation theory plus a liquidity premium. This is what the liquidity premium theory is trying to explain. Right? So what is this liquidity premium? It is effectively a carrot. I was explaining to you the preferred habitats. You prefer to occupy certain location within your house. So to get you out of that location, some carrot, some enticement has to be offered. So the financial markets also like that. Okay, you see the segmented market theory we explained in the previous slides. The pension funds, insurance funds, they are comfortable in sitting in the longer side of the equation. But you need to give them something additional. Let's say additional few basis points of interest rates to get them out of their long end to come and invest in short end. Short end players would not go out from their short end, but if you give them an additional interest rate, they will go to the long end and invest. So some inducement to entice them to come out from their preferred habitat. So that is called some liquidity premium that we have to give, and that is nothing but the motivator for these market participants to move between, right, the maturity structures that we would be looking at. So in that sense, the bonds of different maturities are not perfect, or from another perspective, a partial substitutes. You can actually substitute them. People who are preferring one type of bonds can be convinced to buy the other type of bond, let's say longer term bonds, but you have to entice them with some liquidity premium. So the bonds are now under the liquidity premium and preferred habitat are not necessarily perfect substitute, but partial substitutes. You can entice them by giving them some inducements. It is like in the corporate sector, you've been enticed to work during weekends, late hours, or even for that matter, you've been asked to go on a certain type of activities, responsibilities on the basis of some arrangements being facilitated. Okay, so either a pay-based, if not other incentives-based arrangements. So you get enticed to kind of, move into and actually perform. So the liquidity premium and preferred habitat explain this fact, and here the equation. So INT, I is the interest rate of end period bond, is nothing but the first part of the equation is expectation hypothesis component. Right? So the average of short-term interest rate across the duration that you are looking at, plus LNT. LNT is liquidity premium. So you always enticing somebody to invest by giving them an additional interest component. That's why LNT is always positive, and this explains the fact that the yield curves are normally upward sloping. This LNT component still being positive, yield curve would be downward sloping. If you see the expectation hypothesis component, where the short-term interest rates that you expect across the duration become significantly low towards longer duration. So then the short-term interest rates would look higher than long-term interest rate, despite LNT component remain positive, small positive, right? So LNT component that expects to have a higher liquidity premium as the duration increases. Longer the duration, higher the liquidity premium, because higher the uncertainty. Longer the duration, you know, time from now for 20 years to the future would look very much uncertain, except time from now for 1 year to the future. You are reasonably certain 1 year from now compared to 20 years from now. So the LNT component requires here a liquidity premium, right, that increases with the duration. So that explains the upward slope that could take in the liquidity premium theory. So the explanation is very clear in the form of expectation theory plus an additional liquidity premium in the liquidity premium theory in the form of an LNT in the equation itself. So preferred habitat, I already explained to you. Okay. Investors have preferences for bonds of one maturity or the other. You already know this. They are habitually preferred to buy certain bonds than general bonds that are available in the market. You prefer long term, I prefer short term, fine. There are segments in the market. Okay. They will be willing to buy bonds of different maturities, right? That means the short-term market investors still prefers to buy long-term bonds only if they earn a somewhat higher expected return. That means you have to give them some carrot to get them out of their preferred habitat. Okay, so you know the elephants, they gather in Udavalava during a certain period of the year. Why? The carrot is water. Okay, during that period, the water lodges around the elephant habitats become dry, so they tend to kind of move towards this part of the country, simply because there the water retention still remains. Migratory birds, why they migrate from one part of the world to the others? These are whole enticements, nature's enticements to get them to move from one location to the other. So similarly, you entice market participants, investors, from one of their preferred zones, habitats, to the other by showing them a higher expected return. When they have this higher expected return, you can get them to kind of move between their maturity preferences. But generally, investors prefer short-term bonds over long-term bonds because of the uncertainty of duration. That is, we explained in terms of a segmented market theory itself, right? So generally, people are in the shorter side because lower risk in terms of time factor, duration factor, right? So you generally see short-term interest rates are lower than long-term interest rate. That means upward slope is again explained there. But ultimately, preferred habitat very clearly says that you can entice them from their preferred habitat to another habitat by giving them a higher expected return. So this explains you more or less the way in which the term structure shapes up across these different duration analysis that we were highlighting. Right? So this chart again explains to you the expectation theory where the investors are indifferent. They are perfect substitutes. They always see long-term interest rates are nothing but the average of short-term interest rates. At any given point, if there is an arbitrage, the demand will move to that and take out that arbitrage from the equation. So expectation hypothesis tries to kind of maintain the market participants are indifferent. Then you see liquidity premium, as we were explaining, longer the duration, higher the liquidity premium. So that itself suggests as the maturity, the x-axis moves towards higher duration bonds, the liquidity premium also gradually increases. So that sets the fact that the bonds are generally shaping upward. The yield curves of bonds are generally shaping upward. In terms of the liquidity premium theory, that explains both the expectation hypothesis plus the LNT component. Any questions? Any questions up to now of what we discussed? Right. You can raise any questions in the chat mode also, so we can take up and discuss as we move on. But remember, this sections that I'm discussing is very, very useful in terms of looking at how the markets are behaving to great extent when it comes to all these interest rates developments, and probably now you see with the 19th of this month, the central bank has increased the policy interest rates by 50 basis points. Overnight standing deposit facility rate and overnight a standing lending facility rate was increased by 50 basis points from 4.5% to 5% in the deposit facility rate, 5.5% to 6% of the lending facility rate. Plus, central bank also has asked banks to have higher statutory reserve requirement provisions from current 2% to 4% effective 1st of September. So that has implication across the interest rate structure prevailing in the country. Already we have seen that in the market when we look at the yesterday's interest rates developments. But you should be able to read them, interpret them, and try to understand what's these communications, what these explanations try to explain in terms of what we are now discussing. Very, very importantly, how this would influence the yield curves and through which the prices of financial assets, right? So these are the elements, I mean, we want you to cultivate, gain from this type of programs. apart from getting through your exams. That's the, I believe, the main motive of all of you. That's fine, but you have to also have to kind of see how best you can interpret these developments in financial markets and how this would influence the behavior of market players and financial assets. Right. Then we were explaining these details, so I'm not trying to spend too much of time here. Okay. The interest rates on different maturity bonds move together over time. This is explained by the first term in the liquidity premium equation. That is the expectation theory explanation. Right? So then you see yield curves tend to slope upward when short-term rates are low and to be inverted when short-term rates are high. And which is explained by the liquidity premium term in the first case and by low expected average in the second case, even in the case of liquidity premium theory. As I was explaining, if you have lower short-term interest rates in the future short periods within the expectation theory equation, even if LNP component is positive, the overall shape of the yield curve could become inverse, downward sloping. And yield curve typically slope upward, explained by the LNP component. Very simply, higher LNP component towards longer durations could explain that's generally shape upward. So I left these blanks in the slide itself for you to kind of, fill these based on what you have learned in the discussion. Then you see here, market expectation of future short-term interest rates, right? According to liquidity premium theory. So what you are basically seeing is market expectation. If it is steep upward sloping yield curve, that means it naturally expects future short-term interest rates to be higher and liquidity premium to be higher. Then if you see mildly upward sloping, you don't necessarily expect future short-term interest rates to be higher, but probably the liquidity premium, as the duration increases, you effectively see LNT component driving the mild upward slope in the yield curve. Then you see flat yield curve, which effectively highlight the possibility that the future short-term interest rate somewhat lower than today's short-term interest rate, because this, even after accommodating for LNT, which is positive, still yield curve is flat. And then downward sloping yield curve, this definitely expects future short-term interest rates to be lower. So you should be able to, by looking at these shapes, to explain what's underneath these possible behavior in interest rates or yield curves from what you have learned up to now. That is what is important. That is what is expected from this discussion. Right. Then you see, very interestingly, and different time periods of US, different shapes of yield curves prevail. At the bottom, you see This is after the financial crisis. We are starting those discussions most likely in 2 weeks from now. So what you are basically seeing is July 11, 2011, very much upward sloping, particularly from medium to long-term side of the equation of the yield curve. Then a reasonably flat yield curves in 1980, May 16, March 3, 1997, February 6, 2006. Those were reasonably flat. It's not necessarily flat, but you can see short-term interest rates and long-term interest rates are not much different. Then you see in 85, a mild upward sloping yield curve in the case of US. The 1981 January, downward sloping yield curve. This is immediately after the oil price shock. So you are basically seeing all possible types of yield curve patterns we have discussed and reviewed, elaborated in this discussion. Actually, empirically experienced by financial markets at different points in time. And in Sri Lanka's case too, it's compared to US, not necessarily that efficient, but still you could see these developments in yield curves. So you should be able to interpret them and analyze them and explain them when you see this type of patterns in yield curves from what you have learned. So with that note, I stop this presentation in terms of this topic. Very important, very significant topic. You can read through again. You can follow through the last discussions. It will be very useful for you to understand some of the details that we have discussed and highlighted here. Any question before I move to the new topic, new presentation? You can raise any questions if you have for us to clarify, or even you can jot down your queries in the chat box so we can follow up on that basis. Right. So we can move into the economic analysis of financial structure. Can you all see the new slide, the new presentation in your screens now? I hope you can see the new presentation slides. Thank you. Thank you. So this is about financial structures. This is also to some extent explains what we have discussed. So what you are basically seeing here through financial structures is we tries to understand the requirement of financial systems in place for a healthy and vibrant economies. So what it entices and effectively tries to highlight is the financial systems that basically moves funds from savers to productive investment opportunities. And to make it happen effectively, you need to have financial systems. Okay, so to make sure that these funds are channeled to productive investments is the focus here, rather than unproductive or waste. That is not the intention of any saver or any financial system. They ultimately desires of driving the hard-earned savings to productive investment opportunities. Okay, so this section tries to explain and tries to give you some economic analysis of how our financial structures designed to promote economic efficiency. So if you look at the global experience, if you look at the different financial structures, what it explains is, or refers to, the manner in which the businesses finance its activities, particularly by using external funds, how you are sourcing, how the businesses source their funds, even government source their funds. You may have retained profits, you may have shareholder assets, that's all fine. That is, internally you can raise funds through that type of arrangements. But even if you are raising those funds internally through new structures, new issuances, that is like you are raising funds externally to the organization, let's say new share issuances. Up to now, it's not available to the organization. You are newly acquiring those funds. So basically, the financial structures refers to the manner in which the businesses finance its activities by using externally sourced funds. The analysis here, we try to focus a few simple but very powerful economic concepts that makes and explains the features of our financial systems. Okay, and why you require financial contracts, right? And also why financial intermediaries, that means the banks, financial institutions, are more important than simply the securities markets. That's very important here. So you probably figure it out. Why financial structures, financial systems are very important, given the fact that you require to have financial contracts and financial intermediaries. And financial contracts are still prevalent in securities markets. There's no segregation in terms of financial contracts prevailing in financial intermediation as well as in securities markets. But importantly, financial intermediaries play a very, very significant role in financial structures. We will try to explain them with the economic background, economic explanations, so that would set you your minds being cleared in terms of why those financial intermediation are very important in today's context. Then also we tries to kind of demonstrate the link between the financial system and the aggregate economy, but we will not go into aggregate demand, supply curves, things like that in this exercise. But you have to understand the financial system is complex. And already know that you have different type of financial intermediaries, institutions, banks, insurance companies. You are not familiar with mutual funds in Sri Lanka because we don't have much of a depth in mutual funds. You probably know about unit trust. They play a limited role of mutual funds. You know about stock and bond markets in Sri Lanka too. Those are reasonably established. And often these intermediaries are regulated by the government, by the central bank or Securities and Exchange Commissions. Then you see, we look at the basic facts. We look at basic facts of financial structures, not only restricted to Sri Lanka or developing economies, but generalizing to global financial structures. Right? So ultimately, as I said at the very first slide itself, our aim is to see how these financial structures promote economic efficiency. That means allocation of resources to productive economic activities. We will have a chart. This compares US against Germany, Japan, and Canada. This is prior to the new millennia, but there is no significant deviation in the last 20 years or so, also in terms of these details presented in this chart. Here you are. So here you are looking at how external funds are sourced by non-financial businesses. From what sources non-financial businesses in Germany, Japan, Canada, and US source funds? You can see here from banks and non-banks together. So you see this is financial intermediaries. Banks and non-banks together, it's financial intermediaries. Both Germany and Japan are heavily sourcing their external funds from financial intermediaries. You take banks and non-banks together. In the case of Germany, it's about 86%. Whereas in the case of Japan, it's about 86% again. In the case of US, it is about 56%. If you look at bonds and stocks pooled together, this is securities markets. In the case of US, about 41% being financed through, 43% being financed through bonds and stocks. Whereas in Germany, it's about 15, whereas in Japan, it is about 14. You can take Canada also for the equation and you can try to elaborate the details. But interestingly, Japan and Germany are significantly lean towards financial intermediary finances. The US too, more than half of their requirements being sourced through financial intermediaries. The securities markets, there's a reasonable share in terms of US, but Germany and Japan still not that significant, but those markets are highly developed and highly financially literate, and all check and balances, contractual arrangements are in place. But those two, Japan and Germany, are highly in favor of one type of financial structures that we have studied up to now. If you recall what we have discussed in our previous discussions, lectures, we have discussed about a concept called direct financial structures and indirect financial structures. Direct financial structures are you yourself go to the market and source finances, like issuances of securities, issuances of bonds, issuances of stocks. You raise those funds. Indirect, you are sourcing funds through financial intermediaries. You channel your funds through intermediaries. So what you are seeing here is both Germany and Japan are still today highly in favor of indirect financial structures. Even in the case of US, you can see financial intermediary driven finances are more than half. This is non-financial businesses. We are looking at a segment of the financial market, full market participants. Generally, financial intermediaries source their funds through financial intermediation itself. So to conclude here, what I wanted to say here is across the world, there's a significant dependence of all these developed financial markets into the indirect, if not financial intermediary driven financial sourcing of finances for their business activities. Even in Canada, even in US, there's some development in terms of securities market, but still a very substantive volume of finances are sourced from financial intermediaries. That's why the role of financial intermediaries are that important. And this is developed markets. In developing markets, the securities markets are not this much developed. So there's a natural tendency in developing financial markets, the sourcing of finances to rely more on financial intermediary driven banks and non-banks. Okay, so this itself shows you how significant the markets in terms of its role in sourcing finances, and the financial intermediaries play a very, very significant role in advanced, emerging, and developing financial markets. So the importance that you had to give in terms of sourcing finances still favors, I believe, with the developments that continue to expand, while you see the securities market also expands with the requirements ever expanding given the global financial requirements. So we try to now elaborate 8 facts These are economic facts we try to elaborate through the financial structures in this section. So we conclude stocks are not the most important source of external financing for businesses. You have seen empirically from previous slide, stocks remain one of the, but not the most important source of financing for businesses. Financial intermediaries still remain the most important source of financing for businesses. Then the second fact is issuances of marketable debt and equities is not the primary way in which businesses finance their operations. This also you empirically now know from the details presented there. Yes, securities and debt remains one of the important source of finances, but more than the volumes referred for equities and debt, the financial intermediary driven finances remain substantively higher, particularly in market conditions where we call them as indirect finance driven. Germany, Japan, two best examples in the world, but generally across developing economies also. Then you conclude the third fact. Indirect finance is many times more important than direct finance. This is clear. You have seen the numbers, you have seen the circumstances to which these markets are exposed to that significant volumes or the share of entire market to indirect finance than direct finance. You know what direct finance, what is indirect finance. Indirect finance is intermediary driven finances. Direct finance is you directly source finances from the market. And we discussed this in our previous discussions. Then the fourth fact is financial intermediation or financial intermediaries, mainly the banks, they remain the most important source of external funds used to finance businesses. And this is empirically a fact. Then we see the fifth point we are trying to elaborate here. A financial system, whether it's direct or indirect, remain one of the mostly regulated sectors in any economy. Yes, there are other sectors like health, national defense, right? Transportation, aviation, these also regulated. You can't find somebody's breaching your airspace. There are regulations to the extent where you can shut down anybody who is flying over your airspace. Similarly, you can't breach the waters of a country. There's a requirement to kind of keep informed and get the clearances before you move into. Of course, poaching of fishermen in the northern waters is a common problem we discuss every day. But what is interesting here is financial system in any country remain one of the most regulated. Then another fact is Large, well-established corporations have generally easy access to securities market to finance their activities, and it's very much established. They have the know-how, they have the resources, they have the background to access the securities market and marketing to do, contractual arrangements to do, and they are generally have a easy access compared to a startup or a small business where they don't have that much of know-how or specialization to access securities market. And financial intermediaries have the know-how and specializations to provide that. But the thing is, then the cost would come and play a role. So often, financial intermediary-based finances are preferred by small businesses or the up-and-coming startups. At the same time, the big corporates, they still have big access to financial intermediaries. They borrow even at very cheaper prime lending rates. But at the same time, they also have easy access to corporates, securities market to finance their activities. So these are facts. And then the collateral. When you borrow something, you can't be given the financial facility without lodging a collateral. They would ask you motor vehicles, they would ask you a provident fund, they would ask you a house to mortgage. These are collateral. Or if you have financial assets like bonds, bills, stocks, they would ask you to lodge them with them. So collateral is a feature in debt contracts in financial markets. And then the complication and complexity of debt contracts, the legal documents, and this always plays restrictive covenants on borrowers. So you probably find many clauses like the box, cigarette box, where you see health hazard warnings. There are a number of restrictive covenants when it comes to debt contracts, and these are at times very difficult and complicated. The borrowers of big magnitude of highly established corporates, they're probably well established to go through the details, but small timers, startups, rarely kind of spend time on trying to understand them because that's much complicated. And because of that reason itself, some of the contracts, debt contracts, remain hazardous for these type of small timers. These 8 facts that I explained are very important to understand, right? How efficiently markets are allocating their resources to productive ventures. So I will take you through, and some of the concepts that you will try to understand in this section remains very useful, not only for this particular section, but all throughout this program. Some you have already discussed, some you will discuss as we move on. Any questions before I move on to elaborate some of these details? Right. So in this exercise, or in this section, you will come across the so-called transaction costs. Why financial intermediaries being favored by financial markets or the businesses compared to direct finances? One of the reasons is the transaction costs. Okay, so the financial intermediaries evolve over the years to reduce this transaction cost substantively through various developments. There are broad economic concepts, so-called economies of scale. More the production, the average cost get distributed across each unit of production that you make, and as a result, the transaction cost get reduced as you expand the production up to a certain point. That depends on the fixed cost component of the equation, right? So you see this fixed cost component get distributed across number of units you produce in the economies of scale. More the production, the average cost get reduced. So the fixed costs get distributed across more units that you produce. This is the cost advantage in transaction cost provided by financial intermediaries. So the economies of scale are the cost advantages that enterprise obtain due to size, output, or scale of operation, with cost per unit of output generally decreasing with increasing scale as fixed costs are spread over more units of output. This is the way in which transaction costs get reduced in financial intermediaries, apart from the second element, expertise. The financial intermediaries have built the expertise in terms of contractual arrangements, in terms of collateral arrangements, in terms of accessing information. They have built expertise. They have a team of people repetitively engage in same type of activities. As a result of that, they have built the expertise in the field. So it's natural that a newcomer comes to the market and try to do these things on his own, where he would have time and search cost, which is very costly in today's context, than an established financial intermediary who has already built the expertise in terms of search and time required. And then on top of that, even the documentation, contractual obligations, filing requirements, regulatory requirements, he has already built vast knowledge on those stuff. So the financial intermediaries have evolved to reduce the transaction cost through expertise and economies of scale. And the theoretical economies of scale and average cost explanation is here. As you expand the quantity output, right, the long run average cost get reduced up to a point. Beyond that, then it's get congested, and then you find it's increasing. But up to that point, you find they are beneficial. So the quantity of production increases from Q to Q2 here. The average cost of each unit decreases from C to C1. Right? So anybody produces Q amount of goods, the cost is C. But if you expand it to Q2, still you can substantively increase the quantity that you produce and reduce the cost, average cost of production also substantively, because the fixed cost here being already established and it get distributed to most units of production. So this is the general average cost explanation to have the economies of scale. And you know now the financial intermediaries have the better economies of scale and expertise through which they have much better avenues to reduce the transaction cost in financial structures, financial markets. Then the second point is asymmetric information. And you know already about asymmetric information. We talked about adverse selection and moral hazard. Right? So the concepts of adverse selection, this refers to the possibility of bad or risky trading partners driving away good or less risky ones from the market. And this happens before the transaction. You select the wrong party. You select the wrong party to the transaction. As a result, you have opted for an adverse selection. And because of this possibility, you look at everybody with whom that you contract as risky or bad.
Sir?
Yes.
So can we take the 2008 financial crisis also as an example of adverse selection?
Yes. You are very much there. A financial crisis we will start discussing from not next week, most likely the following week. So you will figure it out how bad the adverse selection problem and which entire financial system in jeopardy, particularly starting from so-called subprime mortgage market crisis in US and spreading throughout the world. And then the problems of adverse selection magnified the issues. So I just request you to be a little patient to get into that topic. We will discuss with greater details, when we come to the point of financial crisis in fortnight.
Thank you, sir.
Any further questions? Right. So you see this adverse selection, right? So because of this element, presence of this element, and the probability that you will pick the bad or risky partners, your pricing in the process is often more tilted in favor of this bad or risky side. So this drive away good or less risky ones because they simply see, why should I go and engage in a business with genuine interest, with genuine expertise for a price like this? And this price is not for me, it is for a risky. So ultimately, the general perception in the market is that whatever remained in the market are adverse, if not bad ones. This is the used car market example that we have discussed at a few points, and again this might come up at in future discussion. This is the lemon problem that we are talking here. So this happens before the transactions. Your selection process happens before the transaction. So you want to make sure, right, So the selection being made, and selections needs to be accurate. This may be one possibility why even today the parents or the elders still keep a close eye on, even when it comes to marriages, to figure it out the partners, right? So these are the social developments, and now that responsibility is taken over by the younger generations for themselves to figure it out whether the partners are ideally and they are making the right selection. So to say that before the transactions you make the right selection is that important in today's context. And the financial markets, in terms of regulation and things like that, they have brought in all this screening, the referrals check. Even for an employment, they do the referrals check, the police reports, many type of arrangement. Even if you go for a visa process for a certain destinations, you have to go through some of these. So that's to kind of reduce the probability of making an adverse selection. The moral hazard. This is the godfather problem. You know your parents are there for you. Because of that, you take more risk than you should be. Similarly, I was explaining to great extent at certain points, when you have a full insurance, you become risky in driving. When you drive a company or the organization's provided motor vehicle compared to your own one, you become a little more risk loving. So these are moral hazard. And you have the medical insurance towards the latter part of the financial year. Even without a real requirement, desire, you tend to have your all medical checkups being done. These are moral hazard behavior. Right? This is after the transaction. So what the financial intermediate or the insurance agencies does is, even if somebody is trying to do right, his price also reflects the moral hazard possibility of the others in the market. So you have to pay a higher premium simply because the general perception, general behavior in favor of moral hazard behavior. That's why after a point, the insurance agencies reduce the insurance premium in motor insurances substantively on the basis of no claim bonuses. Because they built this into the equation that people would act not necessarily to avoid risk, but to some extent to take risk when they have the cushion or the cover. I mean, this is again to some extent the social backgrounds through which that we have been brought up. Also kind of drives when our parents are there, they look after us, they are so much driving us to the right direction. So we are not necessarily taking responsibilities to our shoulders. But at one point when we are exposed to those, you yourself would realize what's the exact role our parents were doing and the price for which that they were paying, where we were being just pampered, if not we are luxury enough to kind of enjoy them free. Right? So the moral hazard probabilities arise after the transactions, whereas adverse selection occurs before the transactions. So another aspect here is the agency theory. This is the principal agent problem. Right? So when it comes to the agency relationships between principals, that is owners, shareholders, and agents of the principals, these are the executives. They run the business, whereas the shareholders, they put their resources into work, and they would not necessarily be engaged in running the business. Right? So the agents or the executives, right? They try to maximize their benefits without giving due considerations to the organization's general standards of, let's say, use of capital goods, even human resources. Because executives are motivated by maximizing the profits through which their bonuses and their power and the benefits. Let's say a machinery which has a running duration of 10 years, which requires certain operations guidelines, that requires to be run, let's say, 16 hours continuously, and requires 8 hours a shutdown. But if you simply see your orders are pending and lined up, you have a profit opportunity, the executives might loosen up. And this is also the argument in recent times, where at certain points where the pandemic related health guidelines were not followed. Whereas the shareholders, they have invested those resources with the expectation that the machinery would last for 10 years. But if you use like this, you probably damage the machinery before that the 10-year duration. So the principal agent problem is nothing new in businesses. This the agency theory very clearly explains, where the agents are motivated by the profit opportunities, whereas the shareholders would be exposed because of this behavior. And to some extent, the principals would not have the background through which they can understand the businesses in depth, because you probably have resources, but the technical know-how would not necessarily be there. So you have to rely on executives. So their symmetry of information affect the economic behavior of these parties to the transactions. So this is also a very important yardstick, very important element in the exercise. And you probably see this adverse selection also a problem. Moral hazard is also a problem. This agency theory also a problem. This all comes because of this asymmetry. So then I was explaining this adverse selection, and I was mentioning about this Lemon's problem. Right? So this Lemon's problem, how this affects adverse selection and influence financial structures. And please try to kind of figure it out. You can search in Google, very old paper, small, not a big reading, but a small reading of a 1970. You probably see PDF or picture scans of not necessarily fancy writing and fancy paper based document, but this Georgia Koloff, he has written a paper, Market for Lemons. Okay, Quality, Uncertainty, and the Market Mechanism in 1970, which examines how quality of goods traded in a market can degrade in the presence of information asymmetry between buyers and sellers, leaving only lemons behind. So, general perception between lime and lemons, the lemons are inferior. I don't know whether it's true or not. So it's open for debate. But the argument here is lemons are the ones left in the used car market. So the quality cannot be assessed. The buyer is willing to pay at most a price that reflects the average. So when you see a used car, the conditions, details are precisely known to the buyer. Sorry, the seller. He's the one who was using it, and he knows to great extent the quality of that product. But the buyer, despite the probabilities of accessing in today's world, various ways of looking at it, but you are not 100% sure you can assess the quality. So buyer is always try to price on the basis of the average price in the market, not the premium price based on actual quality of the used car. Then the sellers of good quality are actually get offended by this price itself because they simply see the price is for average quality. But they themselves are aware to the extent that their product is far superior. Buyers would not budge. They will not decide to buy because what the understanding is, everything left in the market, in the used car market, are generally of poor quality. So you can go back to the facts that we explained, 8 facts in our discussion, and try to relate this to the fact 2 and fact 1, and that tries to explain this. Right. So we will come to tools that used to help this adverse selection problem. But I would like to stop at this point and start from here because that's a good launching pad for me to start my discussion next week. Most likely we will meet again on Saturday usual time. At times where I find my time being demanded for other purposes, so I also opt for Thursday 5 to 7 slot. Some of you might have difficulties to join that time slot. Please see whether, if not, you will have a recording. But I will follow up some of those with the questions that you may have, and we will be able to clarify and discuss. But yes, it's usually on Saturday mornings, this time slot, failing which we'll be able to follow up in terms of Thursday 5 to 7 slot in our classes. So I'm much more happy if you have any questions to answer now. If not, we can conclude the discussion for today, and we will come back with the topic that we are discussing now with another new topic also being introduced in our next class. So with that note, I would stop the discussion if you don't have any questions. Stay safe. This is a very challenging times for everybody, and we'll see you next week. Thank you.